Okay, so the next thing comes fair presentation. So the financial statements and the financial information which is presented to all the concerned parties, to all the stakeholders, it must be fairly presented. So fair presentation means that we do not provide any such information which is inaccurate or which is not clear. So it has to be true, it has to be fair. We call it true and fair view. And financial statements are required to present fairly in all material respects the financial results and position of the business. There are so many examples of fair presentation. I'll just give you here one example, which is actually we will do it in chapter number 8 when we will do tangible non-current assets. But imagine that if you purchased a property maybe 10 years ago for $100,000. And the actual cost at that time 10 years ago it was $100,000. Now 10 years have passed and this property, probably it is a premises, it is office building, it is house, it is not $100,000 anymore. The market price of this property now may be $150,000. So you should change the value in the balance sheet and you should revalue it, so that when you tell shareholders the value of this asset, it should be reflected the fair value, the market value, which is 150,000. So this is something in a simple example of fair presentation. So because if you are showing this asset still at the price of $100,000 value, this would not be an example of fair presentation. And compliance with IFRS will achieve this. So when you follow all the accounting standards, the IFRS standards, and you follow the conceptual framework and you follow the principles, ultimately what you achieve, that is called fair presentation. So I just gave one example, but the thorough completion and obedience of the IFRS will ultimately help you in achieving the fair presentation. Then comes consistency. I already have explained this concept of consistency when I was explaining this comparison or comparability. Consistency means that you should use the same accounting policies from one year to another year, so that the financial statements, they remain comparable. So consistency means the same set of accounting rules should be followed when you prepare financial statement from one year to another year. Historical cost, current cost, realizable value, which is also called NRV, net realizable value, and present value. Actually, these four are the measurement methods for assets, or the measurement methods for other elements of financial statements. So when in your balance sheet you've got assets or you have got liabilities, how do you value them? How do you measure them? So the first one is called historical cost. So historical cost measurement method, it means that the initial cost, the initial purchase at which an asset or a liability it occurs. So for example, if you purchase a non-current asset, historical cost is the price which you have paid in the very beginning. So let me give you the definition for historical cost. Historical cost, it says that the cost of an asset, it includes the purchase price plus any other expenses which are incurred in bringing the asset to present condition and location. Present location means the transportation cost, present condition means the installation cost. So purchase price of the asset plus transportation cost plus installation cost plus any other expenses which you incur to make the asset in up and running condition. By the way, I have written this definition. It is available in your course notes. So don't forget, don't get worried. I'm speaking it here, but it is available in the course notes. So let me explain you with the help of an example of historical cost. For example, if you purchase some asset, some machinery from Germany for $100,000, and now you are bringing it to your own country, so you must pay some transportation cost from Germany to your country. So let's suppose you pay $5,000 as transportation cost. So this $5,000 must be added to the cost of the asset. Then equipment is here. Now it is 105,000, 100,000 plus 5,000, the transportation. But this equipment, it must be installed before it is ready for use. So then you bring some engineers for installation of this machinery, and you pay another $5,000 to the engineers for installation. So now this asset become 100,000 plus 5,000 plus 5,000, 110,000. You should also remember that when you bring this equipment from another country, maybe you have to pay some kind of custom duties, some import duties. Those should also be added into the value of asset. There is one more thing which sometimes is paid, which is called sales tax or general sales tax or VAT, value added tax. So what do we do with the VAT? VAT is, there is a possibility that you may or may not add. It will depend on if you are a sales tax registered business. So if you are a sales tax registered business and you can possibly recover this VAT, in that case you will not add it into the cost of asset, because ultimately you will recover it. So you will pay the VAT, but it remains as your current asset receivable in your balance sheet. It is not added to the cost of the asset. However, if you are not sales tax registered supplier, and if you cannot recover, so you are paying the VAT but you cannot recover it from your customers, in that case this VAT should be added to the cost of the equipment. So historical cost means the initial cost, how much did it cost you at the very beginning, at the very first instance. That is called historical cost. Okay, then comes current cost. Current cost is also called replacement value. So current cost or replacement value means the price or the cost or the value at which an asset can be replaced with another asset of identical condition. So for example, if you have got some computer notebook which you purchased for $1,000, so $1,000 was the historical cost of this notebook, but now you have used it for 3 years. So what is the price or value of a 3 years old notebook in the market? If you want to bring another notebook, very similar condition from the market, how much would it cost? Probably $300. So then the replacement cost of this asset is $300. So its historical cost was $1,000, but its market value as of today is $300. Then comes your realizable value, or what you call NRV, net realizable value. It is also called settlement value. So please listen to the definition. NRV, net realizable value, is equal to selling price minus all expenses to sell and complete. So realizable value or net realizable value, I'm speaking it again, it is selling price minus all expenses to sell and complete. Now imagine that you have a shop, you sell mobile phones. So there is a mobile phone, the price of the mobile phone is $100, and you have some agreement with your sales staff that whoever will sell this mobile phone, you will give him $5 as sales commission, 5% as sales commission. Now if a customer comes in and purchases the mobile for $100, so you know that the customer will pay $100, and then immediately you have to pay $5 to the salesperson. So what comes to you is $95. So for you, this mobile phone has a realizable value of $95. We call it net realizable value, because what do you get in the end? What is the net? The net amount which you receive is 95. Selling price is 100. You sold it for 100. The company or the business gets 100, but ultimately the business gets 95 because 5 is given to the salesperson. So I would speak it again. NRV is equal to selling price minus expenses to sell or complete. Expenses to complete means that probably the customer comes in and says, I will buy this mobile phone for $100, but I need to have the cover for the screen. So please put a plastic cover on screen which is for $3. So in that case, the customer pays 100. You put one cover for $3, you give $5 to the salesperson, so $8 are gone. What you get in the end, what is net? That is 92, and 92 will be NRV. So NRV is a very important concept. We use it very frequently, and especially you will use it in the valuation of your inventory, which is our chapter number 7. When we will do chapter number 7, you will see that there are we use this concept NRV very frequently. Then comes the present value, which is also called economic value or value in use. This concept you need to pay a little bit more attention. So it says that it is the present value of all the cash flows generated by an asset during its useful life. So present value of all the cash flows generated by an asset during its useful life. So let's first understand present value. Now actually this concept is from financial management, which is your paper FM or F9. But what I need, I will not go into a lot of detail how to calculate it, but just let me give you the concept. The basic concept is that $1 today is not equal to $1 tomorrow. You know that money loses value with time. Whatever you can buy with $100 today, maybe after 3 years it cannot be bought for $100. You have to pay maybe more, probably $120. Now, why do you have to pay more, and why does money lose value? That is a long debate. We don't go into that, but we just can simply say that there is some concept of inflation. So some inflation is happening, and due to that the money is losing value. So $1,000 today probably is a big amount, but $1,000 after 20 years would be a very little amount, because after 20 years this $1,000 will lose value. So that is the concept of present value and future value, which is also called discounted cash flow. So imagine that you have to receive $1,000 after 3 years. So it is $1,000 in cash. It is $1,000, but it is after 3 years. How much it is in today's term? What is the value of this money in today's term? So in today's term, it would be less than 1,000. Probably it is $800, or probably it is $900. So this 800 or 900, it is a symbolic value. It is called present value. So it means that the cash which you will receive after 3 years, $1,000, in today's term, it is only 800. So this is the concept of present value. Now the definition says that economic value or present value or value in use, it is the present value of all the cash flows generated by an asset during its useful life. So an asset will generate cash flows in next 3 or 4 or 5 years. How much cash flows it will generate, and what is the present value of that? Let's see it with the help of an example. Imagine that you have got an asset which has a useful life of only 3 years. Year 0, it means today. Year 0 means now. So there is an asset, probably a car, which you can give on rent for only the next 3 years. And this is only the life of this asset with you, 3 years, and in 3 years it will generate some cash. So I'm saying $5,000. This $5,000 is not profit. We say cash flows. It is not the profit. Cash flows means that when you use the asset, there is some cash in, plus there will be some expenses which you will pay out. So imagine that it is a car, you are giving it on rent. So you receive the rent, then you pay for fuel or maintenance or whatever. So in 1 year, this asset gives you $5,000 in cash. And then in year 2 and year 3, it again gives you $5,000 in cash. So total cash which you receive is 5 plus 5 plus 5, 15,000. So the hard cash which is in your hand will be 15,000. But the point is that you do not receive this 15,000 today, or you do not receive this 15,000 all at once. You receive this 15,000 in 3 parts, 5,000, 5,000, 5,000, end of year 1, end of year 2, and end of year 3. Now we want to see that how much the present value of this $15,000, because cash is 15,000 but value would be less. So this is a process where we use discounting. So I'm sure that when you will do F9, you will learn discounting, but if you are interested, you can go on to Google, just make a search for discounted, you would find a lot of material on that. So this $5,000, probably its value is 4,700 as of today. So it means that today's 4,700 is equal to 1 year later's 5,000. It means what you can purchase today for 4,700, for the same thing, if you want to buy after 1 year, you would need 5,000. How did I calculate 4,000? Is it 4,700 or not? I'm not going into details. I'm not showing any formula because that would be too complex at this level. Just imagine that this is 4,700. Then for year 2, the 5,000 which you receive at the end of year 2, in today's term, its value is only 4,500. Value is, so whatever you can purchase in 4,500 today, to buy the same thing, you would be needing 5,000 after 2 years. Just a very simple thing to remember. Then comes year 3, and the cash $5,000 at the end of year 3, its present value as of today is 4,300. Now when you make a total of these three numbers, it gives you 13,500. So it means that this asset, actually it looks like that it is giving you 15,000, but the actual value of that 15,000 is what, 13,500 as of today. So this 13,500, it is called the economic value, or it is called the value in use, or you may call it present value. So these are four methods of measurement of the elements of financial statements. And as I mentioned earlier, don't be afraid. The definitions and explanation of all these four, they are available in your course notes. You can read